Believe it or not, your dream home might be turning into a financial nightmare in 2023. In this video, we're diving deep into the world of home buying during these unpredictable inflationary times. Is it truly the smart investment everybody claims it to be, or are we headed towards a financial pitfall that most are oblivious to? Stick around as we uncover some truths that the real estate market doesn't want you to know. By the end, you'll have the knowledge to make a wise, informed decision that could save you from the potential ruin. Plus, a bonus tip that could change the game for potential home buyers. Hey everyone, I'm Darren Hunter, and today we're diving deep into the world of primary residences, investment homes, appreciation, and inflation. You've probably heard that buying a home is one of the best investments you can make. But with today's rising cost, is your home really keeping up as an investment? Stick around as we crunch the numbers and decipher what this means for you. If you find this information helpful, please do me a favor. Hit the like button, comment your thoughts, subscribe for some more insightful information. I certainly appreciate it and look forward to seeing you on the next video. All right, first of all, let's clarify some terms. Your primary residence is the place you call home. It's where you build memories, celebrate holidays, spend most of your time. On the other hand, an investment home is a property you buy not to live in, but to make money from, either through renting it out or selling it at a higher price in the future, Airbnb-ing it, long-term rentals. That's an investment property. Now let's talk numbers. Appreciation refers to how the value of your home increases over time. But there's a twist. Inflation is the general increase in prices across the board. So while your home might be increasing in value, the cost of everything else is going up too. So to give you some perspective, the most recent reported CPI numbers showed that inflation was up by 3.2%. But guess what? The value of your house appreciated by 7.7%. So your primary residence is, as an investment, is beating inflation. We'll deep dive into those numbers some more so you can make an informed decision about home and finances. Okay, one of the ways to judge an investment is by comparing it to some sort of safe investment. And right now, the safest investment out there is namely your short-term treasury bills or your T-bills. They're government-backed securities, often considered the gold standard for risk-free investment because you have the full faith and credit of the U.S. government. But here's the thing. While they're stable and reliable, the returns aren't always that exciting. They're certainly not sexy, especially when we weigh them against the potential of real estate. Now, let's shift gears a little bit and think about that same money in a primary residence. The numbers might paint a different picture. With housing appreciation rates and inflation dancing their tango, your primary home might not always offer the same level of guaranteed returns as the current interest rate on a T-bill, which is around 5%. But here's where the debate gets rich. A primary residence isn't just an investment on paper. It's where memories are built, where children grow up, where holidays are celebrated, and where you find comfort at the end of a long day. Can you really put a price on your child's first steps taken in your living room? Or those family barbecues in the backyard? These are intangible returns of joy, security, belonging, and things that a T-bill just cannot offer. While we do weigh the financials, it's important to remember that a primary residence serves a dual purpose. It's an investment and a home. T-bills offer stability, but your home offers both financial growth and a lifetime of memories. Leverage is a powerful tool in real estate. It's the most powerful tool. Simply put, it means using borrowed money to finance a part of or the entirety of an investment. So imagine being able to control a $300,000 property with just $60,000 of your own money. That's the essence of leverage. Let's say you buy a house worth $300,000 with a $60,000 down payment. That's 20% down and the rest is financed. If your property appreciates by just 5% in a year, that's a $15,000 increase in value. Without considering any other expenses, which of course there are, your return on investment isn't just 5%. You've gained $15,000 on your initial $60,000 investment. That's a whopping 25% return on investment. This is the magic of leverage. But leverage is a double-edged sword. It can magnify your gains, but it can also magnify your losses. If that $300,000 property decreased in value by 5%, your $60,000 investment would take the brunt of that decline. It's essential to understand and be comfortable with the risk associated with leverage. Work with the professionals, be it a financial advisor, real estate agent, a certified mortgage advisor. Make sure to ensure you're making informed decisions. The goal is to maximize the benefit and minimize the risks. And just as with the primary residence, leverage isn't just about the numbers, it's about maximizing potential. It's the potential for better neighborhoods, better schools for your kids, and a community you can resonate with. Every dollar you leverage might mean a step up in the quality of life for you and your family. There are two main types of property purchases people make. Buying a primary residence, of course, and buying one for investment. Your primary residence is, well, your home. It's where you live, relax, raise your kids, celebrate milestones. It's filled with memories, laughter, and sometimes tears. An investment property, on the other hand, is primarily about the numbers. It's a strategic purchase aiming for financial returns. Think rental income, tax benefits, and hopefully appreciation. Understanding the fundamental difference is crucial because while the heart often drives a primary home's purchase, the head and a calculator typically leads to investment decisions. There's three pillars we're going to talk about. Pillar number one is cash flow. Cash flow is the money you pocket every month after the bills are paid. For homeowners, think of it as the difference between your mortgage payment and your expenses. For investors, it's the rental income minus expenses. Why does this matter? Consistent positive cash flow ensures that your property pays for itself. Over time, even small monthly profits can add up, especially when you're considering the power of compounding, and that is the secret. That is the key that we want to take advantage of. But remember, not all properties will have positive cash flow immediately, depending upon your mortgage, location, rental rates. It may take time. That's why it's essential to evaluate potential cash flow scenarios before making a decision. I can tell you personally, I do not purchase properties unless I'm seeing a positive cash flow right out of the gate. Pillar number two, appreciation. Appreciation is the rise in your property's value over time. Historically, real estate has been an appreciating asset, but it's not guaranteed, as we've learned back from the housing bubble. Several factors influence appreciation. The broader economy plays a role. Local job growth, infrastructure developments, and even school district ratings can have an impact on your appreciation. For homeowners, appreciation means your home's worth more than what you bought it for. For investors, this can lead to a higher sales price down the road and can help you take advantage of those compounded returns. Cash flow plus appreciation. It's worth noting that while appreciation is a significant benefit, betting solely on it can be risky. Always consider other factors. That's why, again, cash flow and appreciation plus pillar number three are vital. Pillar number three, loan amortization. Amortization sounds complex, but it's just a fancy term for gradually paying down your loan. And that is if you're taking advantage of leverage. That's the third part of the compounding return we want to see. Every time you make a mortgage payment, a portion goes to the interest and a portion pays down the principal. Over time, you're building equity, which is a portion of the property you truly own. For investors, here's the cool part. Even though you're paying the mortgage, it's typically the tenant's rent payments covering these costs. In essence, they're helping you build wealth. That's what we want. By the time the mortgage is fully paid off, not only do you own the property outright, but due to appreciation and consistent maintenance, its value has likely increased. There are plenty of opportunities to use leverage to take advantage of some cash out options down the road as well as that home continues to appreciate and you gain more equity. When you combine cash flow, appreciation, and loan amortization, you harness the trifecta of real estate wealth building. Each pillar reinforces the other, creating a resilient and potentially profitable structure. Whether you're considering buying your first primary residence, thinking of dipping your toes into the world of real estate investment, or just curious about where to begin, remember, every journey starts with one single step. Give me a call, I'm happy to help. It's not just about the property, it's about the potential memories, potential profits, and potential futures. Navigating the world of real estate can be challenging, but with the right guidance, your dream home or investment is within reach. If you're ready to explore this exciting world, or even if you just have a question, reach out. I'm here to guide, advise, and help you turn your vision into reality. Please do me a favor. Remember to comment below. Love to hear your thoughts. Please like the video if you found it informative. If you didn't find it informative, don't like it. Subscribe, stay up to date on the latest real estate insights and strategies. Your next chapter in real estate starts now, and this is a guaranteed approved message. Have a great day.